By virtually all metrics, the second quarter of 2014 was one of the most robust we've seen in years. There was a notable increase in demand with office space, with more than 15 million square feet of positive net absorption recorded during the quarter, the highest quarterly tally since 2007. The U.S. vacancy rate dropped 30 basis points during the quarter, and rents once again rose, with the national average lease rate climbing by more than 1% for the second consecutive quarter. Two factors drove the strong quarterly numbers: healthy job growth and historically low levels of new construction. The U.S. has added an average of 231,000 jobs per month so far this year, a step up from last year's sub-200,000 monthly pace. Yet, there is very little new supply delivered to meet increasing demand. This supply-demand imbalance is pushing rents higher and vacancy lower in many U.S. markets, resulting in fewer and, in some cases, more expensive options for occupiers to choose from in the marketplace. The U.S. office market's performance was widespread, with around two-thirds of the markets tracked by CBRE recording drops in vacancy during the quarter. Notably, smaller office markets like Las Vegas, Portland, Detroit, and Tucson posted the largest local quarter-over-quarter declines in vacancy, reflecting the broader nature of both the U.S. labor and economic recovery. Most of the major markets also performed well. San Francisco and Manhattan, the two tightest markets in the U.S., continue to see robust demand, further pushing up already high rents in those markets. The red-hot tech sector continued to lease up space in virtually every major U.S. market, but financial services was active as well, inking deals in markets such as Atlanta, Chicago, Denver, and Miami. Well, the U.S. economy has now improved to the point where many occupiers and investors feel that it is on the cusp of a period of sustained growth, despite the first quarter winter weather-influenced weak GDP number. This optimism is chiefly due to stronger job numbers. In June, 288,000 jobs were added to the economy, and the unemployment rate dropped to 6.1%, its lowest point in 6 years, capping off a strong first half of the year for the labor market. U.S. corporate profits have also been healthy so far this year, which has helped prop up the stock market and, more important to commercial real estate, provided many occupiers more flexibility to make capital investments, including a greater willingness to expand their office portfolios. While there are some headwinds, such as slower economic growth in emerging markets and strife in parts of Europe and the Middle East, to date, they have not materially impacted the U.S. recovery, although investors and occupiers alike are paying close attention to these headlines. Well, we expect the U.S. office market fundamentals to continue to improve at a healthy pace during the latter part of 2014. We anticipate the national rate will keep falling, but only modestly, as a slight spike in new supply anticipated in the second half of 2014 should partially counterbalance increased leasing activity by occupiers. Rents will also continue to grow, even with the slight increase in new supply. Companies should expect a more competitive leasing landscape in the coming months. On the investor front, the Fed is expected to wrap up its asset purchase program in the coming months, which should result in gradually rising interest rates. The question for investors: can rising rents offset higher borrowing costs? If so, cap rates should remain essentially unchanged or increase only slightly in the short term. Well, amid geopolitical and economic uncertainty abroad, foreign and U.S. investors alike were squarely focused on safe haven investment properties, in particular U.S. commercial real estate, during the first half of 2014. Debt and equity for capital for real estate investment was plentiful, and interest rates hovered near historic lows. As a result, transaction volumes remained robust, and cap rates for core CBD office properties continued to drop. Those suburban office cap rates leveled off following a long period of compression. In essence, despite Fed tapering, borrowing costs are still relatively low, providing investors a compelling and unexpected window of opportunity to lock into attractive terms to buy assets or refinance existing loans. Given the relatively low interest rates and the improvement in leasing fundamentals, we expect aggressive bidding for U.S. office assets to continue in the latter part of 2014.